What if I told you that there's one number that professional real estate investors check before they even think of buying a rental? It's called the cap rate. And once you apply this to a potential rental property, you'll instantly know if the property is a solid long-term investment or if it's a trap in disguise. Most people only look at cash flow, and this is a mistake because cap rate tells you something that cash flow completely misses, and that is how stable or how risky an investment actually is. So by the end of this video, you'll be able to look at any potential rental investment and calculate the cap rate in under 30 seconds, and the results of that calculation will tell you whether or not a potential rental investment is actually worth your time looking into further. And then later in the video, I'll go over the exact mistake that made me lose everything in 2007 and how I could have avoided that had I known about calculations for risk like cap rates. Now, cap rate or capitalization rate is a snapshot of a property's return if you paid all cash for it. No mortgage, no financing, no nothing. It answers one question. If I bought this property in cash outright, what percentage of return would it give me every year based on its income alone? Now, here's a formula to calculate cap rate. It's very short. It's net operating income divided by the potential purchase price. Now, before you go, oh, whoa, what is net operating income? Let me explain that really quick because it's actually pretty simple. Your net operating income is your rental income minus your operating expenses. That's property taxes, insurance, maintenance, management, vacancy, but not your mortgage payment. Let me reiterate this. The cost of your mortgage payment is not a part of your net operating income. So cap rate deliberately ignores financing, but this is why it's powerful. It strips out how you personally financed a deal and shows the property's raw investment performance. This is the part that a lot of people don't understand, even some seasoned investors. Two investors can buy the exact same property, one with all cash and one with a loan. Now, their cash flow rates will be completely different, obviously. However, their cap rate, exactly the same. And that's the whole point. Let's say you have a property that you purchased for $200,000 and its annual net operating income is $14,000. So the cap rate would be $14,000 divided by $200,000, which would result in 0.07 or a 7% cap rate. That 7% is what the property itself earns, regardless of how you paid for it. That's the number that seasoned real estate investors compare across all potential rental investments they look at. And here's another thing that separates amateurs from professionals. Amateurs use cap rates to find good returns. Not a bad idea. But professionals use cap rates to find hidden risk. Well, so what do I mean by that? Well, a higher cap rate normally means a higher risk. Think rougher neighborhoods, older buildings, more management headaches, less demand, and less stability. A lower cap rate, on the other hand, usually signifies a lower risk. Safer areas, stronger tenant demand, more competition to buy, and more stability but a smaller immediate return. You can think of a cap rate like an interest rate that the market will pay you for taking on that property's risk. There's a parallel to this in bonds. A junk bond pays a high interest rate because it's risky. A US Treasury bond pays a low interest rate because it's more stable and safe. Real estate kind of works the same way. Cap rate is the market pricing risk into a property, just like bond yields price risk into debt. Now, if you know of Warren Buffett, for a long time he has said that risk comes as a result of not knowing what you're doing, not necessarily from an asset itself. A property with a 10% cap rate isn't automatically a bad deal, just like a property with a 4% cap rate isn't automatically a good, stable deal either. But if you don't understand why the cap rate is where it is, then you are investing blind. So the cap rate number isn't the answer, it's actually the question. It forces us to ask, now why is this cap rate so high? Or why is this one so low? Once you can effectively answer that with confidence, you're thinking like an investor. You see, I didn't understand this distinction early in my investment career, and it cost me. I was chasing returns without understanding risk, and that's a dangerous habit in real estate. Now, pivoting a little bit from real estate, when I was 17, I was working a job and I had saved up $3,500, which was a lot of money at the time for a 17-year-old. And I started investing in the stock market, specifically in options. I started writing what's called covered calls. And I was doing okay and making a little money. But then the dot-com bubble burst in March of 2000, and not only did I lose all of my profits, I lost all my seed money too. That was my first real education in risk. I didn't understand what I didn't understand, and the market punished me for it. Fast forward a little bit, and at age 22, I became a general contractor and started building and selling homes. And again, I was making a little money, gaining a little bit of confidence. Then 2007, 2008 hit, and the real estate crash wiped me out. I lost everything I had invested. But here's the thing, I actually felt kind of lucky because I only lost my investment capital. I knew builders in the industry and developers who lost everything and had to file for bankruptcy. These were millionaires that went from millionaires to nothing within a matter of months. The crash did not discriminate between beginners and seasoned builders. Remember how I said at the beginning of the video that a little risk evaluation could have saved my nest egg? If I had understood how to evaluate risk the way a cap rate teaches you to, instead of just chasing the excitement of building and selling homes, I would have seen the warning signs before 2007. You see, I was so focused on profit potential that I didn't stop for a minute and go, wait a minute, what happens if the market turns? Fast forward to 2010, and I bought a duplex in a solid middle class area that was stable. I lived in one side of the duplex and rented out the other while I was fixing it up. This is a strategy that today is known as house hacking, and it's still one of the best strategies that I recommend to people starting out today. See, but the catch is the duplex didn't make me a millionaire, but it has brought in consistent income every month, and it remains the best investment that I've actually ever made. Why? Because by then I understood risk, I understood stability. I wasn't chasing the highest possible return anymore. I was building something durable. That duplex, if I calculate its cap rate today, sits in a healthy, stable range for its market. And that's not an accident. That's what happens when you evaluate a property for its underlying risk profile, not just how exciting the potential upside sounds. Here's how the pros actually use this number, not just to evaluate one single property, but to compare different markets against each other. For example, a rental in a small Midwest town might have an 8 to 9% cap rate, whereas the same type of property in a major coastal city might only have a 3 to 4% cap rate. That doesn't mean the coastal city is a bad market, or even a good market for that matter. It simply means that investors are willing to accept a lower rate of return because they're betting on long-term appreciation and stability. But the Midwest property will pay you more today because inherent in its pricing is more risk and less appreciation potential. Think of how hard is it possibly to find a renter in the small Midwest town, so your vacancy rate is going to be potentially a lot higher. Sam Zell built his fortune by understanding what the market was pricing into a cap rate on a particular piece of property. He bought properties that the market was afraid of at cap rates that reflected fear rather than the fundamentals, and finding the ones where the fear was overblown. Sam Zell didn't avoid high cap rate properties out of fear. He studied why the cap rate was high. And if the underlying risk wasn't as bad as the market thought it was, he would buy because he was getting paid extra for a risk that actually wasn't even there. You may have heard of Ken McElroy as well. Ken McElroy has over $1 billion of commercial and residential properties in his portfolio. And when evaluating potential property investments, he stresses looking beyond just one single number. He talks about using a cap rate alongside a deep understanding of the local market, the property condition, and the management quality before making a decision. Ken McElroy's approach is a great gut check here. Cap rate gets you in the door, but it should never be the final number that gets you to close on a property. It's really a filter, not an actual final answer. And here's something that almost nobody tells beginners, but when you hear it, you'll go, oh, yeah, that actually makes sense. Cap rates move. When more investors want to buy in a particular area, that competition will drive up prices faster than income, and cap rates will compress, meaning they'll go lower as a result. On the flip side, when an area falls out of favor or maybe interest rates rise, prices generally fall relative to income, and cap rates will expand, meaning they go higher. So, understanding where cap rates are moving within a market is a potential indicator of where you're buying in the market. Are you potentially buying at the top, or are you getting in early? Now, Warren Buffett and his late business partner Charlie Munger built one of the most impressive investment records in history around a core idea: the margin of safety. Margin of safety means buying an asset for a little less than what it's actually worth, or ensuring the investment numbers work even if things go wrong. This builds in a little bit of a buffer in case the market turns against you. This is exactly what I did not have in 2007. I had upside, but I did not have a margin of safety. And when the market turned, I had no cushion to absorb the hit. But by 2010, with the duplex, I unconsciously began applying this margin of safety principle. I bought in a stable, middle class area where the numbers worked even if things didn't go perfectly. And that margin of safety is probably why I still have the property and it still cash flows today, and I didn't freak out and sell it when I hit a bump in the road and things got temporarily hard. Let me give you a couple of common cap rate calculation mistakes to avoid. Mistake number one: comparing cap rates across different property types. A 6% cap rate on a single family home and a 6% cap rate on a 40-unit apartment complex are not apples to apples. Different property types have different risk profiles and definitely different management demands. Mistake number two: trusting a selling agent or owner's NOI calculations without validating or verifying them. Sellers will often leave out very real expenses or input really unrealistic vacancy rates in order to make the cap rate look better than it actually is. Always rebuild the net operating income or NOI yourself using real numbers. Tax records, utility bills, comparable rents in the area, these all need to be taken into account and calculated yourself. Mistake number three: ignoring deferred maintenance and capital expenditures. A property can show a fantastic cap rate today and still need a new roof, new HVAC, or new plumbing next year. Those costs won't always be reflected in the net operating income, but they will be reflected in your wallet if you buy the property. Mistake number four: using cap rates as the only metric. Cap rates tell you about risk and return relative to property purchase price. It doesn't tell you about the neighborhood trajectory, local job growth, or even population trends. Pair cap rates with other market research. Never use it in isolation. So, what's our cap rate routine when we go to look at a potential investment property? Step one: calculate the net operating income from real, verified numbers. Never trust what you see on the listing flyer. Step two: divide the net operating income by the purchase price to get your cap rate. Step three: compare the cap rate to similar investments in the same market and the same asset class, not properties across the country or in a totally different category. Step four: ask why the cap rate is where it is. If it's a high cap rate, what's the hidden risk? If it's a low cap rate, what's the expected appreciation or stability that's priced in? Step five: build in a margin of safety. Make sure that even if things go a little wrong, the numbers still make sense. And then only at step six do you integrate your financing into your analysis to calculate your personal cash on cash return. So that's the cap rate framework that investors use before they even get on the phone to call about a property. This process takes less than a few minutes once you get into the flow of things and you really know what you're doing. And it can save you from more bad deals than any other tool in your toolbox. So I've built homes, lost everything twice, and eventually found the strategy that actually works consistently, like house hacking with a clear eyed understanding of numbers like cap rates. I'm not teaching this from a textbook. I'm teaching it from having made every mistake that it's meant to prevent. If this video broke down cap rate in a way that finally made sense, please let me know by hitting the like button. And if you know of anyone else that would appreciate the content of this video, please share it with them. And remember, the number one reason that people lose money in real estate investments isn't necessarily due to the bad market. It's due to skipping the calculations and the analysis that would have warned them about the bad market. So don't skip the cap rate. And if you want to see how I bought my first rental property with very little money, go ahead and click this video here. And thanks for hanging out.